Hey there, thank you for taking the time to visit my website and to watch this short video. Today's presentation is going to be about how retirees and pre-retirees can potentially avoid going broke in retirement while keeping their nest egg secure and growing. Did you know that an estimated 40% of all US households are projected to run short of money in retirement? This, according to the Motley Fool, is the number one concern that retirees have, running out of money. Now, by watching this short presentation, you will learn the biggest mistake that most retirees and pre-retirees make and what you can do to easily avoid it. You know, the focus of my practice is working with people either navigating through retirement or preparing for their retirement years. And I speak with many people, and almost everybody has the same types of concerns. Maybe they have known somebody in their own personal lives who didn't plan well and ran out of money. Perhaps they're just afraid that they're not doing the right things with their money. Or maybe they're not concerned with growing a huge net worth. They're happy, they're comfortable, they just want to keep what they have and maintain their current lifestyle. Now, when thinking of a person's financial life, it's really helpful to picture Mount Everest. If you're a mountain climber, you know that there are three clear legs of the journey: the ascent, the summit, and the descent down the other side. The ascent, this is the climb, and it's all the hard work. It's the blood, the sweat, and the tears. In our financial lives, it's the long uphill battle of your working years, of wealth accumulation, saving money, investing, and building for your future self, and building for your family's legacy. Now, the summit is the culmination of all that hard work. It's the accomplishment where you firmly plant your flag as a rite of passage. You've reached retirement. Congratulations. And then finally, the third phase of the money cycle is the descent, which one would think would just be the easy part, just climb down. In our financial lives, it's the part of the financial life cycle where we put our exit strategy to work for us, managing our wealth and navigating it as we ensure that we maintain our lifestyle and now not outlive our resources during our golden years. But you may be shocked to know that of all of the deaths that have occurred on Mount Everest, 80% of them have occurred during the descent. Our financial life cycle follows much the same trajectory, as retirement is filled with the same hidden dangers as descending Mount Everest. And just like Everest, most Americans fail, financially speaking, upon the descent. Why? Because they haven't properly developed a sustainable exit strategy or a distribution model that will see them through their retirement years. Today's course is going to show you why most people get into trouble on the descent down the financial mountain and how I can help you prevent that from happening to you. Now, what I'm about to teach you is going to be a huge paradigm shift for you. And that is simply this: that once you retire, average rates of return no longer matter. Let me say that again, because I know that's a huge paradigm shift. Average rates of return do not matter once you retire. What matters much more is the order in which you receive those returns. You'll see in this example on your screen that we have a 10-year span, and this is a hypothetical example, but in this example, you see that we have an average return of 6%. Now, I want you to notice that the first 2 years, we have really great returns. And then the middle 6 years, we have just 10% each, just decent returns. And then we have really dismal returns at the end. So we start with $100,000, and to keep things simple, there are no additions and no withdrawals, and the average return is 6%. And at the end of those 10 years, the investor ends up with $154,764. Now, what would happen if we reverse the order of those returns? Well, you'll see in this example that we have the same average return of 6%. And you'll notice that the dismal returns are the first 2 years. And then we have the middle years, still the same thing with decent returns of 10%. And then our 2 great years of returns are toward the end of this cycle. Again, the average is 6%. And again, you end up with $154,764. There's no difference. During somebody's working years, there's no difference the order in which they receive their returns. Again, sequence of returns doesn't matter during the accumulation phase. And this probably isn't too exciting for you at this point. You already know this, right? So where is this paradigm shift that he's talking about? Well, we'll see because it's coming up next. Now, this is the same example, okay? Except this is somebody during their retirement years during the distribution phase. We start with $100,000. We have average returns of 6%, but now we're going to withdraw $6,000 per year, okay? So this example is going to mirror before. We're going to have our really good returns at the beginning of this retirement cycle, and then we have 6 years of decent returns, and then we have 2 years of bad returns at the end, okay? So again, the average is 6%, and he's withdrawing money out of the account as he goes along. So after 10 years, he actually ends up with $105,544. So even though he was withdrawing from his account for 10 years during retirement, at the end of those 10 years, he still has more than what he started with. That's fantastic, okay? But now let's reverse the order. You're going to see that in this example, we have the same example with $100,000 to start with, the same average rate of return of 6%, but you'll notice that the dismal years are in the beginning of this retirement cycle. Then we have 6 years of decent returns and 2 really good years at the end. And again, the average return is 6%, but this time, if the retiree is drawing from the account and the bad years happen toward the beginning of his retirement, it absolutely decimates his retirement portfolio. After 10 years, he ends up with less than $39,000. But wait a second, this is the same average rate of return. It's an average return of 6%. How is this possible? Well, look at the numbers. You'll notice that when an investor takes substantial losses early on and he's withdrawing from the portfolio, he depletes the account so substantially that he's never able to recover, even though he has great returns over the last 8 years of this cycle. This is how it works. This is called sequence of returns risk, and you just saw it in action. Drawing from your money when the balance is down makes it nearly impossible to recover, which can be devastating when you're in the distribution stage of the money cycle. Now, historically, the stock market has come back, but that takes time that you may not have as a retiree drawing from your assets because you need income to live on. This paradigm shift goes against what most financially savvy people have experienced because for their entire lives, they've been a saver and they've been an investor. They've grown used to checking the average returns on their IRA, their 401k, their stocks, and their bonds. And if they can get a 5% average rate of return, that, of course, is better than 3% average rate of return. Or if they can get 7% average rate of return, that, of course, is better than a 5% average rate of return. So people grow up thinking that average rates of return are what really matters. Now, during their working years, it is. However, when you retire and enter the distribution stage, when you are climbing down the mountain, the rules of the game change completely. Both of the portfolios shown on your screen have identical average returns, but very different outcomes, right? The only one difference between these two portfolios, the portfolio on the right lost money early in retirement, and the portfolio on the left lost money much later in retirement, and it had much less of an impact. Now, here's the thing. This isn't anything that you can control. Neither can I, nor any other investment advisor. The market is going to do what the market is going to do. My point is this: if you retire and if you are unlucky and we see a bear market or the market crashes shortly thereafter, that's out of your control. But if you haven't planned for it, you are in deep, deep trouble. You have to carefully plan to neutralize the sequence of returns risk. Now let's look at a real life example coming up about historical market returns. But again, remember the key is that losing money in the early years of retirement can hurt you, okay? Now look, here is a graph of the S&P 500 performance over the last 20 years. Look at that volatility. Look at the high highs and look at the crashes and the really low lows. Imagine being a retiree who had all of their money still invested in the market and then having to sell during the dot-com crash or having to sell during the 2008 financial crash just because you needed income to live on. What kind of impact would that have had on their portfolio? Now, some investors have followed the conventional wisdom and moved most of their portfolio to the so-called safe haven of bonds. But remember, in the midst of trying to save our economy and prop up the markets during the financial challenges, the Federal Reserve has slashed interest rates to zero. And they have been at or near zero for over a decade now. Now, this has drastically affected the way that most retirees in America are able to retire. Being able to achieve a 6 to 7 safe or a safe rate of return in a bond fund or a CD, live off the interest and preserve your principal, those days are gone. And the more that the Fed tampers with and interferes with interest rates and with the money supply, the more and more volatility we have. So we are in a vicious cycle. This new normal of severe market volatility consisting of extremely high highs followed by severely low lows, that is going to continue to happen and most likely is just going to get worse. Now, earlier I showed you a hypothetical example with easy rounded off numbers to teach you the concept. But does that principle apply in real life? Show me the numbers, Ron. Show me the math. Look, let's apply it to the real world. Because bond interest rates have been so low, most people right now are trying to stick it out in the stock market. But look at this example and what a difference just a few years can make with the sequence of returns. In this example, we have two retirees and everything about them is the same. They're both invested in the S&P 500 index. They're both withdrawing $30,000 per year and they both start with a nest egg of $500,000. The only difference is that George retired in 1997 in the middle of a bull market. And so he had a couple of good years before the dot-com crash happened. So 20 plus years later, he still has money left. But notice Jane on the right. She retired in 1999, and her first 3 years of retirement were in the midst of a bear market. Look at how the distribution and the sequence of returns affect her portfolio balance. Because Jane's first 3 years were down, down, down. Look at her third year. By her third year of retirement, her portfolio balance has been cut in half. And unfortunately for Jane, she's run out of money in just 12 years. Now here's the thing. George didn't do anything right, just like Jane didn't do anything wrong. It's all a matter of luck. If you retire and if you are unlucky enough and the market doesn't agree with you, the sequence of returns risk will wipe you out. We have to plan to neutralize this risk as much as possible. By far, the biggest mistake that I see people make is trying to go from the accumulation phase of their lives directly into the distribution phase of their lives. They're leaving themselves seriously exposed to market risk and the sequence of returns risk. And who are the most susceptible to the sequence of returns risk? It's people who are in what I like to call the retirement red zone. People who will be retiring within the next 5 years, or people who have just retired within the last 5 years to where they're just starting to draw from their retirement assets. These are the people who are most susceptible to the sequence of returns risk. So what's the solution? It's to add a third phase to the money cycle. In our strategy, we implement a third phase called the preservation phase. So we preserve and protect a portion of your assets segmented into their own buckets. And this preservation money is earmarked for conservative growth and reliable retirement income. By adding the preservation phase to the money cycle, we are now creating what I like to call a volatility buffer. This is where we're strategically positioning a portion of our assets to keep them safe, yet continue growing them to outpace inflation. But this money is specifically earmarked to generate your retirement income for the first phase of retirement. By implementing this strategy, you will greatly neutralize the sequence of returns risk. Sounds extremely important, and it is. And maybe it sounds a bit complicated, but wouldn't it be awesome if there was a system in place that could help you to accomplish all of these things and avoid the common pitfalls that many retirees make? Well, there is. It's called the bucket plan best interest philosophy. I'm going to explain it to you here real quick. One of the most important things I've learned in nearly a decade of financial services is the KISS principle. Keep it simple, stupid. Financial planning can be complicated. even for those of us who are experts in the field. What we love about the bucket planning best interest philosophy is a very simple yet very effective way to take a very complex concept and break it down to where it's simple enough that clients can understand it. It's super simple, yet very, very effective. What it all boils down to is strategically segmenting and positioning your assets to accomplish different goals, where all three buckets work together. Let me give you a quick summary. The first bucket is the now bucket. And quite simply, this is money in the bank. It's your emergency fund. It's for planned expenses. It's for whatever you feel comfortable with, whatever you need, not tied up in a long-term investment, not subject to stock market risk, safe, liquid in the bank. Maybe it's 12 months of spendable income, whatever is comfortable for you. Bucket number 2 is the soon bucket. And this is the game changer. This is the preservation money. This is where we implement the volatility buffer. Okay. The purpose of the soon bucket is to provide steady, reliable income over the first 10 years or so of your retirement life cycle. Now, I know that 10 years probably doesn't sound very soon to you, but it is a fairly short time frame in the universe of investing. The soon bucket is a more conservative type of money that doesn't experience the volatile trends that are more common to the traditional stock and bond portfolios. With this bucket, you're conservatively investing money that you will need over the next decade. So we're not going to subject it to the dangers of the market or interest rate fluctuations or bond prices or the sequence of returns risk. Now, because it's more conservative, you likely won't have sky-high returns with this money, but there will be some growth. We target a 4 to 6% average rate of return so we can try to outpace inflation without taking on undue market risk. So even though we're setting aside 10 years worth of income, the soon bucket may very well last you a good 12 to 15 years. You'll be able to relax throughout that time, knowing that your immediate income needs will be met. And finally, that brings us to the later bucket. The purpose of the later bucket is to provide long-term growth for the second phase of retirement income. Since you've secured a time horizon with those first two buckets and you have at least 10 years worth of income, you can confidently commit to investing in the later bucket without having to worry about day-to-day market volatility. Why? Because we're not forced to take distributions during bear markets. So thus we eliminate the sequence of returns risk on this portion of your money. In other words, if you can mentally accept the fact that you won't be accessing these funds for 10 plus years, then you should be able to commit to an even more growth-oriented investment strategy, even with above average volatility, because we can potentially achieve very, very favorable outcomes in the long term. History shows us the more time that we add to the investment horizon, the more risk that you take off the table, and the more that you increase the odds that the investment will end up producing very favorable results. Now, many retirees who don't implement this plan or don't implement the soon bucket, they think they're well diversified. They've got some money in the bank, but most of their money is in that later bucket where it's in the equities market. And in reality, they are seriously exposed to market risk and sequence of returns risk. When they experience a downturn in retirement, you saw how that volatility can wipe people out as they're taking distributions from their retirement accounts. So what happens when an investor doesn't have a soon bucket and they experience significant volatility? Well, they end up making grave mistakes based on emotion. They end up getting out at the wrong time. They're getting back in at the wrong time. This can dismantle the entire plan and significantly reduce long-term outcomes. And this is the path that most people take. But you're not most people. The proof of that is that you're taking the time to educate yourself by watching this video. Now you can see all three buckets working together are going to give you confidence that you'll need to achieve substantial growth in your portfolio over the long term, even though you've allocated a portion of your money to more conservative strategies and income. The presence of the soon bucket helps to remove the emotional decision-making so the investor is now more confident to stay the course and not make poor decisions, even during a bear market. By committing to a long-term investment plan, they can improve their overall outcomes. It's simple and it's powerful. The bucket planning best interest philosophy. Curious? What's the next step? Well, if this information sounds like it would be helpful to you, immediately below this presentation, you're going to find a calendar link where you can click to schedule a complimentary consultation. We can do that consultation in person in my office, over phone, or via Zoom webinar. And I would be remiss and probably be in a lot of trouble if I didn't at least flash up my disclosures about the registered investment advisory firm that I work with, the insurance companies that I work with, and to disclose the fact that even though we do some tax and legal planning, I am not a tax accountant or an attorney, so we'll make sure to get your other professionals involved in the process as well. So I thank you so much for taking the time to watch this educational video. My information is on your screen. You can either click the calendar link below or contact me at my phone number or at my email address, and I look forward to working with you.